Okay, before we begin our market outlook, we do have our hats available for sale now. If you go to our homepage and you scroll down, you will find it down here. Just click on Get This. If you're outside of North America, we just can't ship it. When I say North America, I'm particularly meaning Canada and the US. We do have shipping in place for that, although it's not that cheap, unfortunately. But to get it to places like Europe or India or Australia is just too ridiculous to get there in terms of the price just for shipping. If you do want to help support Pathstone, you can click on the link here, Pathstone Mental Health, and this page will open up. Click on Donate, and when you can click on Other to put in any amount that you want. Under Designation, just click down here and put Mark's hats for Pathstone so that they can see that our program is helping to support them if it doesn't come through the hats. Let's go back to the hat sales. If we click on Get This, you will get to a page that has the hats available. Our target is 200. We've already sold 45. And it is 30 US. I match it with another 30 US, which is 60 US, which is close to 80 bucks Canadian. So every hat sale ends up being an $80 contribution towards Pathstone. So I do match the full $30. The full 30 that you spend for the hat goes to Pathstone, plus I match it with another 30 US. So we've sold 45 of the 200. We've only had this up, I think, 3 or 4 days now. And our total donation to Pathstone is 2,700 US, and you can multiply that by whatever the exchange rate is now, 1.338, to see what the Canadian total will be. If we hit the target of 200, that would be 12,000 US, which is somewhere around 17,000 Canadian. If we hit the target of 200, I will then up it all the way to 25,000 and just write a $25,000 check to Pathstone. So we do have some motivation here to get it to 200. 155 to go. If we hit the 200, that then bumps it up by I'll be contributing another 9,000. Roughly 9,000 on top of the combined amounts of the hat plus my matching contribution to make it a $25,000 gift for Pathstone. Okay, at the very end of this video is about an 11-minute interview with one of the people from Pathstone, where I just asked some questions to see if we can't get a better idea of exactly what it is that they do. Because when we talk about mental health, it seems to be such a broad definition these days that the definition of what it is has creeped to include almost everything, that it's hard to really understand exactly what it is. So I sort of put that question to this person. I say, can you define it a little bit better and tell us exactly what you do? So if you're interested in knowing more about them, at the end of this market outlook, I think the last 10 or 12 minutes of this video today is an interview where you can get a little bit more information about exactly what it is that they do. Okay, let's begin. If you were watching curve inversion this week, you were not disappointed. We have hit, for the 10 to 2, we have hit a new low point. Not only just a new low point for this particular period of time, but we've taken out the lows of the past 1, 2, 3 recessions, and the curve is now inverted to the early 1980s level, the 2 to 10. Negative 69 basis points. We've been inverted here for 137 days now. Got a long way to go before you can take out the 1980s. That curve got inverted to like negative 200 basis points. We're at negative 69 right now. So here are our yields over the course of the week. We can see that they all went up, except the 20 and the 30 dipped. The 1 to the 3 hit new highs. I expect that to happen every week. As you get closer to the next FOMC meeting, you're going to have a 50 basis point increase. This will walk its way up to the lower end of the range, 4.25. This will walk its way up to about 4.5 as you get closer to the December meeting. And this will walk its way up to a combination of a weighting of 1/3 of the December rate, 1/3 of the next January, the following January rate, and then 1/3 of the final rate. So it'll be a little over 450. So these will continue to increase. We get the minutes, the FOMC minutes in 3 days on Wednesday, and this is a shortened week. We have Monday, Tuesday, Wednesday, normal operations. There is no Thursday, so Thursday is gone, and Friday the market closes at 1. So it's a shortened day on Friday. December 14th is now only 24 days away for the next meeting. And if we look way down here for this week, we have 75, almost 76% probability of 50 basis points and 25% of 75. The extra weight on the 75 happened over the course of the week. There was some Fed speak over the week, which I said last week, expect to hear that. And, they're going to browbeat the market and try to keep the market down because they don't want financial conditions loosening. And that is what they did. If we look at the 3-month to 10-year, which has so far a 100% track record, taking out, of course, the pandemic, because that was an exogenous event. We don't know whether or not we would have had a recession or not had the pandemic not happened, but all the signs were clearly pointing to a slowdown. We are now negative 52 basis points on that curve. That's now 25 days that it has been inverted. February 07, it got to as low as negative 60, just 8 basis points to go, and we take out the February 07 depth. And December 2000 was as low as 77 basis points. You take that out, we're all the way at the beginning of the 1980s again. For the Fed balance sheet, it continues to run off, ending November 16th, another $42 billion gone. $40.4 billion from U.S. Treasuries and $1.6 billion from MBS, so it is now sitting at $8.114 trillion. Last week was $8.156 trillion. Fed funds futures. What we're seeing here is higher for longer. So look at last week, May and June were both equal with an index at 95.12, implying a high-end rate of 4.88, so 4.75 to 5% as the peak rate. That is now being pushed out to July, 94.93, and at 5.07 for the peak in the rate. So we went from May, June being the peak at 488, got pushed all the way out to July, peaking at 507, higher for longer. December 95.27 implies 4.73 at year end versus last week 95.54, which was 4.46. So over the course of the week, we on the 2s to 10s set a new low on the inversion for this period. We're now back to the 1980s. We're still inverted on the 3s to the 10s. The Fed funds futures moved out further for the peak rate before we hit peak, and we're peaking higher, and we added more weight to 75 basis points for the December meeting. Okay, this is a new chart that I'm adding in. We can look at it every now and then. I don't think it's worth looking at every week. It's a forward curve. And on this curve are 3 different sets of rates. 1 month of the secured overnight funding rate, the 3-month secured overnight funding rate, and 1 month LIBOR. The circles that you see here, that's the Fed dot plot, and the blue one that you see here is the median rate on the dot plot. I'll show you where I got this chart shortly. You can see it was updated as of November 18th. So let's make sure we know what we're looking at. For SOFR, this is a secured overnight funding rate. It is meant to replace LIBOR. LIBOR was a survey-based interest rate, whereas SOFR is a market-based rate. It is published by the New York Fed every day for the previous day. So you can go to New York Fed and you can get these rates. If I were going to lend you money, I'm going to charge you, let's say for 1 month, I'm going to charge you an interest rate. You're not the government, which means the loan I give you is not risk-free. If you were the government, well, you would get the government rate, whatever the 1 month rate is, because it would be risk-free. But if I lend you money and you give me a 1 month T-bill, you've basically made sure that my loan to you is risk-free, because the collateral I have is a risk-free collateral. So by proxy, you've given me a government guarantee on the loan I've given you. So the secured rate for the 1 month should reflect where the 30-day T-bill rate would be. So we can look at the 1 month forward curve to determine, because the Fed has told us its preferred measure of curve inversion is to look at the 3 month minus the forward 3 month rate 18 months out. So that you go 18 months out and you look at what a 3 month rate is. You need a forward curve for that, and you compare it to the current rate. Well, we can use the overnight funding rate to get to the same conclusion. The current 3 month overnight rate is 4.31. The forward rate is 3.93. You do have inversion there as well. LIBOR is an unsecured rate, and it's not a market rate, it's a survey rate. It's being phased out. The very short-term rates are gone. What is left is the 1, the 3, the 6, and the 12-month rates, and they end June 30th, 2023, and then it's over. So let's look at a few things on this curve. First, we'll look at where the peak of all the rates are, and we're only interested in the secured funding rate. The 3 month peaks at 5.04. The 1 month peaks in between the April and June. That kind of plateaus out there between 5.01 and 5.05. When we looked at the Fed funds futures, we saw it peaking in July at 5.07. So this is 5.04, 5.1 to 5.05. It's right in and around that neighborhood, which we would expect it to be. So it peaks at that level. We expect that we'll end 2022, the median from the dot plot is 4.375, which is the midpoint between 4.25 and 4.5. This is ending 2022. Where are we going to end in 2023? The midpoint is 4.625, which is midway between 4.5 and 4.75. So this is 4.25 to 4.5. This is 4.5 to 4.75, which means 50 basis points higher a year later. 50 basis points higher could simply be that kind of move, or could be like this, right? And that is what this is showing, is that it will peak sometime during the course of 2023, and come down into the end of 2023, but still end at a higher rate at the end of 2023 than at the end of 2022. These may be stale dots because we got those in September. On the December meeting, we get a new dot plot and we get a new summary of economic projections. Let me show you where I got these curves from. Okay, this is the site for Chatham Financial. The link is in the description box. You'll land at this page, which gives you just an overview of a bunch of different rates. Click on the forward curve, and there you go. You'll get an interactive chart. You can click and unclick what you need. If you scroll down, there's this neat little thing down here. See how past forward curve projections have stacked up. Click on View Now, and you'll get a clear chart of this. Okay, real rates have all increased over the last week, but still have not taken out the previous highs that we had in place. All of the break-even rates have continued to move lower as well. Some of the Fed speak that we had last week, Bullard mentioned 5 to 7% range based on different variations of the Taylor rule. But he is expecting peaking somewhere between 5 to 5.25. I think he was just trying to make a point that, listen, I think we're going here. And if you think that's unrealistic, the Taylor rule suggests somewhere between 5 and 7%. But the headline came out as 7%. And that caused the market to sell off some 1.1, 1.2% based on that. But he was just saying different variations of the Taylor rule, say 5 to 7%. So 5 to 5.25 is within that range. Mester and Collins saying, yeah, we'll probably be going higher than what you think, but they didn't give any particular target. Collins still says 75 basis points is still on the table for December. That 50 is not a done deal. 75 still on the table. Kashkari just says, well, that's an open question. Didn't want to commit to it. But he did have an interesting tweet during the week. The entire concept of crypto is nonsense. It is for greater fools. And greater fools is a theory suggesting that there are some assets that you buy that only have value if you can find a greater fool to sell it to. Bostic, on the other hand, says he's ready to move away from 75 basis point hikes in December. And he thinks there's only 75 or 100 basis points left before they pause, which would put it between 4.75 and 5%. Bullard is 5.2 to 5.25. Mester's not really committing to anything, no particular target. Collins still thinks 75 is on the table. I don't know. I think it would be hard to move to 75 in December, given what we saw with CPI and PPI. I think 50 is pretty much on the table. It would take, I think, a significant rally in the equity markets above 410 on the 4100 on the SPX, and maybe a hot read, a strong jobs market and a hot read, or a not so benign read on inflation before the next FOMC to hit 75, I think. If we look at the jobs market, initial claims 222 for November 12th versus 226 for November 5th, which was up from 218. The week before was 218 and 214. So we can see, 214 up to 218 up to 226. Still in the 220s, but coming from 226 down to 222 is, not really showing a job market that's giving up a lot of jobs right now. And if it stays this way with 19th to 26th, if you see in around the 220 mark, then yeah, your December jobs report is going to print another gain, probably on par with what October printed. So I don't know that the job market is going to give the Fed any leeway to go lower than 50, and it might push them to 75 if they feel that, the economy's strong, the job market is good, inflation's still a problem, market can handle 75. It might want to push to 75, which is why you still see on the first screen of this video a 25% weight is still sitting on 75 basis points. Okay, let's look at mortgage rates and housing market, and then we'll go on to credit spreads. This is from Mortgage News Daily. You'll recall last week I made the distinction between how they give us rates versus what the mortgage market survey does, which was just survey based. However, this is good news here. And because of this, I think I'm going to switch to the PMMS each week for our rates. 30-year fixed 6.63 versus 6.61 from the primary mortgage market survey. Here, the 15-year fixed 6.05 versus 5.98. They're much closer together because of the change, and this change started November 17th. So let's see what they did here. Freddie Mac, and this is where we can get this from, made a number of enhancements to the primary mortgage market survey, which is shortened down here to PMMS, to improve the collection, quality, and diversity of data used. Instead of surveying lenders, the weekly results are now based on thousands of applications received from lenders across the country that are submitted to Freddie Mac when a borrower applies for a mortgage. So it's going to be the actual mortgage rate. So that's why I put here and it's moving closer to actual. The survey will no longer publish fees, points, or adjustable rates, so you're not going to get the 5-year or 1-year adjustable rate mortgage. And this was put in place November 17th. So we will use the primary mortgage market survey. This really is the one, the benchmark for the market. Most of the mortgages given are 30-year fixed. There is a small market for 15-year and even some for 20-year fixed, but this is the main one here. It's more condensed, it's smaller, so we'll use that, and it gives us the additional information on the side, which we're not getting over here. I have to keep writing it in. So we are going to shift to this new form of information. Last week, mortgage applications were up 2.7%. Refinancings are still down, as they should be. There's no financial reason why you would refinance your mortgage at this point. Purchases up 4.37. National Association of Home Builders, the Housing Market Index, 33. This is a diffusion index. Anything under 50 is a shrinking market. Anything over 50 is an expanding market. This is last December here. You can just see the fall off over the months. 33 is a 12-month low on this. Well, for what I have up here, it's the lowest of the previous 12 months. Building permits for October were down 2.4%. That's month over month. Housing starts for October were down 4.2% month over month. Existing home sales for October down 5.9% month over month. None of this is good at all. I put on a couple new trades. DHI, DR Horton. I have a December short straddle. 85 call, 80 put for 555. So my break even is 90.55 on the upside, down to 74.95, 74.45 on the downside. I think this is more likely than not. I think under 80 is more likely, which means it'll be put to me, which I'm hoping. My average price will be 74.45. I've also added to my IYR short position with more short calls. I sold the December 80 for 690. So I had the 84s when the market rallied and IYR went up. I sold 86s, 88s, 90s, 92s because I have a very large position in REITs. And in home builders. I do have some home builders. I have the XHB as well that were going along for the ride. If those turn around, the IYR goes down as well. So I'm using this to hedge out what I think is some downside risk because the market is slowly starting to price in higher rates for longer. That's going to find its way into the pricing of the present value of the cash flows for those REITs, which means I do see downside for IYR and I see downside for the long REIT positions I'm holding, but I like the yield on the REITs I have. I don't want to buy and sell the REITs I have. I want to protect myself from the downside, but some of these REITs have no options. So you can't sell calls on them. So the IYR is a very good proxy for this. Also, it's a very good proxy for this as well. What takes DHI down below 80 will take the IYR down as well. So in essence, I kind of have two premiums working in my favor here. I will show you a chart of this shortly, and I'll show you the chart of how these are related to each other, how they've been moving in combination. But first, let's go to Realtor.com. Okay, so we have our changes year over year in 4 variables here. Week ending October 29th, November 5th, November 12th gives us a bit of a 3-week trend. Median listing prices 12%, down to 11.7, down to 11.1. So we're heading towards single-digit year-over-year increases in the median listing price. Hasn't been under 10% for a very long time. Let's see, active listings went from 40% up to 42, now up to 45. That speaks to the level of inventory and what's available for buyers. Time on market, 6 days slower, 7 days slower, 8 days slower. But if you put that into context, pre-pandemic, sure, it may take 45 days to move a house today, but pre-pandemic, it took anywhere from 65 to 70 days. So it is still 20 to 25 days faster now than pre-pandemic, even though median listing prices are significantly higher and the 30-year fixed rate mortgage is more than double. If we think we're at the end of the rate hike cycle, I mean, we are looking at a 10-year right now that's sitting at 3.82. So let's say that it gets to 4.25 by the end of the hiking cycle. The spread, an average spread between a mortgage, 30-year mortgage, fixed mortgage, and the 10-year treasury is about 200 basis points. That would put the 30-year fixed somewhere around 6.25. Even if we think the 10-year gets to 4.5, The highest we've seen on the 10-year so far is 4.25. That's the peak on the 10-year. But let's push it to 4.5 with another 200 basis points on a mortgage, puts it to 6.5. And we saw on the previous screen that it's sitting at 6.62 now. That I think that being that the narrative is going to be that we're near the end of the hiking, we're not going to be cutting anytime soon. We're going to be on pause, but the end of the hiking, I think the high on the 30-year mortgage is probably in as well. I think the move on the mortgage rate is to the downside now, that maybe after the December meeting when we have more clarity on where they're going to go, maybe after the minutes we might have more clarity of where they're going to go. But if we think that they're going to stop in another 75 or 100 basis points, I think you could see the fixed rate, the 30-year fixed rate, start moving more towards 6% by year end, which would just improve affordability. So I think that we're closer to a bottom in the housing market and in the mortgage market than not, which is why I'm interested in getting exposure to more home builders at this point, because I do think that we're at the bottom or near the bottom. And you want to buy into a particular market under two conditions. Number one, that market is not going away. And number two, nobody wants that market. And there you're going to get it at the cheapest price, because if there's no reason to buy, that's a great reason to buy on its own. And if the market is simply not going away. We still have a structural housing shortage in the U.S. And if you look at the data we saw on the previous screen of the housing market, building permits down 2.4%, housing starts down 4.2%. These are the beginnings of the new base of inventory. Well, if those are negative, where are the homes going to be as mortgage rates start to drop and buyers start to come back into the market? And they're not going to be there. So that's just going to make that shortage a little bit worse. So yeah, I'll take exposure to home builders now. Let's just pop over to this chart over here. This is the 30-year fixed rate mortgage versus the yield on the U.S. Treasuries. The average across that's about 200 basis points. If you wanted to download this data and do a little bit more quant on it to get to exactly what the average is over different periods of time, going into a recession versus coming out of a recession, that might give you a little bit more clarity on how far you think mortgage rates would move from where they are. I seem to think that mortgage rates are more likely to drop than rise at this point. Okay, OAS, all of them decreased over the week. We don't have Friday's number, we have up to Thursday, but all of them have decreased. If we are concerned about an upcoming recession, it is spreads that we want to start paying attention to. This is U.S. corporate bond issuance. We can see here it's been 2 months now that it's been under 100 billion for the month of September. We had less than 100 billion for the month of October, less than 100 billion. And this down here is a chart I got from SIFMA.org. We'll visit that in a second. It's the total market issuance for U.S. Treasuries, MBS, corporates, agency. Agency are government agencies that are issuing debt. Don't confuse that with agency MBS. Agency MBS would be under MBS. Munis and asset-backed securities. Gives you third quarter of 2022 versus third quarter of 2021. And this is quarter over quarter, and this is year over year. Look at total issuance here, 3.1 trillion versus 2 trillion for the quarter. U.S. Treasuries 1.2 down to 919. If we look at corporates, 441 down to 298. This is for the quarter. When we say less than 100 over here, that's only for October. So if you were looking for the third quarter, you're looking for July, August, September in here, and the corporates in here. That totaled 298. And it gives you quarter over quarter the drop, and year over year the drop as well. This is year to date 2022 versus year-to-date 2021, and you can see all negative numbers in here except for the agency. That's the only one that's increased, 158 up to 245. So this is issuance, and to get some idea of liquidity, you can look at average daily volume. This is in billions. So quarter over quarter, all negative signs, right? Year over year, negative signs. I shouldn't say all, negative here, and year to date 2022 versus 2021, you have negative, negative, negative. So if you have decreasing average daily volume, you have decreasing liquidity. So for U.S. Treasuries, when we hear, well, you know, liquidity is dropping, well, it was a 6% drop in trading quarter over quarter, but year over year, 0.8%. And year to date 2022 versus 2021, up 2%. Let's have a look at this site. Lots of really good information on this site. Okay, so this is the landing page. Up here, advocacy and resources, click on that and you'll get this page. Click on research and insights and click on statistics. And there you go, U.S. fixed income. This is the whole class: mortgage-backed securities, asset-backed securities, agency debt, U.S. Treasury securities, muni bonds, money market. Here's corporate bond statistics. If you scroll down, there's the chart that I showed you on the previous screen. You can download an XLS. When you do, it asks you for your personal information because it's going to email it to you. I'll show you the email that you get, but you can download it'll give you a whole bunch of different spreadsheets for each of these market categories that we saw on the previous screen: MBS, ABS, Treasury securities. This is really neat over here, the fixed income market trends. You just click on this and it gives you this this chart. This is 2-year intervals, so each of these blocks is a 2-year interval. You can have it set up as 5-year intervals, but it's got information here. So if you want to know what something is made up of, you could just click on this and it'll expand. Agency, we can see here, was 10.7 trillion, non-agency 1.5 trillion. Just click on go back if you want to see more on Treasury securities, how they're broken down. It gives you, you know, for each year. If you want to click on a particular year, it'll open that year up in terms of how much was issued of each type. Bills 3.7, notes 13 trillion, bonds 3.4 trillion. This is for 2021. So you can play around on this one. You can see your years across the bottom over here. Let's just head back over here. We'll go back a couple more. U.S. equity and related statistics, corporate bond, U.S. money market, U.S. muni bonds, Treasury securities. There's a whole bunch of stuff here depending on what you're looking at. Let's have a look at the email that you would get if you registered. Okay, so you'll get an email, you know, dear Mark, thanks for requesting access, and all of these are links. So all of these are separate spreadsheets. Let's have a look at one of the spreadsheets that I downloaded. Okay, so I had just clicked on U.S. agency debt. It was the first link, and you get a spreadsheet. The first page just gives you a brief description of what's going on. You can click each of these links here and it'll give you, it'll send you right to the proper tab, or you just go to the bottom of the screen. There's issuance. And it goes all the way back to 96. And it tells you what they've issued. Kind of uninteresting. It's, like I say, agency debt is the debt issued by the particular government agency. And I've highlighted 2022 for you here. Year over year change, month over month. This one's not as interesting. Trading volume, they have really small font. You gotta sort of increase the font if you want to see a little bit more. Okay, the DXY still sitting in the 106 region, ending at 106.93. Our 200-day moving average sitting at 106.11. The 50-day moving average sitting at 111.11. So the 50-day moving average is still greater than the 200-day moving average. That's at least something bullish for the DXY. There's not a lot of fundamentals that we can go on with DXY. We can't look at much. Currencies are brutally difficult to forecast. So oftentimes you're looking for technical levels. We are sort of nearing the end of the rate hiking cycle in the US, while other countries are still increasing their rates. They haven't signaled that they're near the end yet, so that should put the DXY under some pressure. We have a support zone 105 to 106 roughly. 105 from the last reversal from the primary trend here. And 106.11 being the 200-day moving average, and resistance on top of the uptrend. The previous uptrend is going to be resistance, which is right near where the 50-day moving average is at about 111. When the 50-day, if the 50-day turns down and crosses below the 200-day, that is a very bearish indicator. And the DXY would probably be traded in accordance with that. Once you get down through 105, 106, if you're looking at the previous uptrend for any support points, 101, 68, 97, 85, but more than likely, depending on how it gets there, you'd be drawing new downtrend channel, and this would act as your support, and this would act as resistance. So it's just too early to tell where, if we break down through 105, 106, where it could go. That's not as important as knowing that the DXY right now is not regaining the high levels, and if the Fed is going to step down, I don't think the DXY is going to break out to any new levels on Fed anticipation alone. I don't think the DXY is going to break out to new higher levels. If there is some exogenous event in the world that raises the price of risk, then yeah, you could see the DXY move upwards to new highs. But just on the pressure of interest rate differentials alone, I don't think so, because you have a rate of change, right? You had rate increases, and then you're going to have the Fed doing this, whereas you have other countries that are still going to be increasing. So the rate differentials, it's expected, will get wider and wider between the U.S. and other countries. Even if that rate differential is in a deficit right now, it'll get more narrow before it gets wider. It's this right here, this inflection point in the rate of increases, that's going to put the DXY under pressure. You get below 105, 106, you get below the 200-day moving average, well then down we would go. So in terms of the two currencies that I've been looking at, the CAD and the peso, I'm not ready to give up on either one of these long positions. I want to see what happens in this zone first. If we do break below the 200-day moving average, I probably would lean into a long peso position and maybe add more. As far as the Canadian goes, I think we had seen 132.50. and we had a little bit of trouble there. We're sitting at 133.8 right now, and this is primarily because of the pullback in oil prices. The Canadian dollar sort of went along with that one, but a breakdown below 105, 106 could put the Canadian in position to break the 32.50 and get to 130. I don't know if we're going to see 125 again, with a recession pretty much a lock for Canada, with a recession probably for the U.S. Not a lock, but probably for the U.S. The safety of the U.S. dollar, I think, will trump the Canadian dollar. So I don't know, the Canadian dollar in a recession could get to 125. But in the near term, before year end, if the 200-day moving average on the DXY does not hold, we could see 130 on the CAD. The peso still sitting solidly with a 19 handle. I saw it as low as 19.3, sitting to anywhere between 19.3 and 19.6, trading in this range. And as long as the U.S. dollar is under pressure, I think the peso gets stronger, which means this exchange rate gets lower. This 19.3 means one U.S. dollar gets 19.3 pesos. I think you could potentially see maybe the upper 18s, see an 18 on here, 18.9. Okay, let's look at the VIX. We're still within this I wouldn't call it a channel here, this flag formation. 23.12. November 4th, we were at 24.55. That's 2 weeks ago. 24.55, we're now 23.12. If we look at skew for the December options on SPX, this is not SPY now, this is on the index itself. We have to look at where it was at the money, and this is where we are. The dotted line is where we ended on Friday. This is 2 weeks ago, which is the straight line over here. So this is the drop in implied volatility for at the money options for the December expiration. The VIX will be a constant 30-day IV. This is not. This is 14 days lower, so there's the drop in IV here is not going to be proportional to the drop in the VIX level over here. What we can pay attention to is the level of skew. We have 8.4 as of November 18th versus 5.2 on November 4th. And how I get that is I take the level that we are at, let's say 2 weeks ago. We take the at the money level and you'll go 10% down and 10% up, and you'll look at the implied volatility difference between these two, and you'll do the same thing with whatever this level is. You will go 10% back and 10% forward, and you will look at the difference between those two. So you can see that skew has increased 8.4 versus 5.2. Now this doesn't, we can't really read too much into this. You have the level of volatility dropping while skew is increasing. So let's interpret that. What it means is that on a relative basis, not an absolute basis now, but on a relative basis, investors have a higher demand for puts versus calls. Now that doesn't tell us on an absolute basis. It could be that 2 weeks ago the level of put buying was far higher than the level of put buying today, but not relative to the amount of calls. This is just telling us now that we have more interest in buying puts relative to the price of calls. That could also be a function of the fact that with lower implied volatility, puts become cheaper. Maybe it's worth buying some insurance into the end of the year. Still though, at 23.12, that is still elevated implied volatility. Under 20, you'd have to get, I think, at this level here, 15 to be in a nice, really calm market. But we do have, just sitting down here, support. So if the VIX falls to here, it might signal a top in the, a near-term top in the SPX, which might trigger some selling and higher put buying to push us back up on volatility. As it stands right now, I can't read too much into the VIX. It's not really telling me anything one way or another other than where it's currently sitting right now. Based on what happened in the last week, it's just a big it's neither, excited nor fearful. So not a lot of help from this. Okay, let's look at SPY here. I think this is the big thing is where are we going? Last week we held the levels fairly well. We had resistance from 405 to about 408, and we did not break that level of resistance at all. And we seem to be kind of well supported around 391, 392. At least that's what we saw last week. And we do have narrowing resistance and support levels. They're not so wide apart, but they're getting rather narrow. And when you combine some of the technical levels of support and resistance with the fundamental ones, they overlap quite well. So it is worth looking at what the more obvious technical indicators would be. 50-day moving average sitting at 378.05. The 200-day moving average sitting at 405.81. So we do have a support and a resistance level here. We do have a gap in the chart. So based on our closing, we have a downside gap on a closing basis daily. That's 381.14. Well, actually 381.14 would be the high point of the candle, which would close the gap. but it's a daily bar. If you used hourly bars, you'd have a level that's much lower. 381.14 on the downside gap, which is below where we were supported over the week, 391, 392. You also have an upside gap in here as well. If you look back here, we have an upside gap. You'd need 408.52 to fill in the upside gap. Our downtrend line is showing resistance at about 408 as well. So we seem to have a lot of resistance clustering in and around 405 to 408. And our uptrend, our short-term uptrend over here shows support at 383.70. You have your 50-day at 378. Also, what's interesting here is you see these little formations over here? And you see this one over here? This one was formed with a downside gap and then an upside gap. That creates what's called an island gap. And usually when you see an island gap where the price gaps up, hangs out there for a while, but then gaps right back down and creates a price gap in between these two sides, where it's like a little island all on its own. That's usually a reversal signal, so that you can pretty much, if this went to here, off you go, you can get a near-term target by just reversing what, the move that led to the gap. Well, look what we have here. We have a gap here, and we have what looks like to be a little bit of an island here. Will this be a smooth transition down or not? Or will it continue up? If it does gap down and creates an island, then your near-term target would be 370 on the S&P. So the price action, whatever price action we'll get, will tell us whether we have one of these island gap reversals. But we do have an upside gap and we do have a downside gap. And so we have sort of a magnetic pull both ways, if you believe all gaps are filled. And you have support at the 50-day and you have resistance at the 200. And here we'll note that the 50 is less than 200, which is still a bearish trend. So we are still in a downtrend. So you may want to refer to this as a bear market rally, and you would not be wrong. By the definition of what a bull market is, this has not met the definition of a bull market, so this is still, by definition, a bear market rally. All right, this brings it all together. Let's overlay some fundamental levels on this, and let's see where we get to. Closing price on SPX for Friday, 39.65. Forward EPS is now lowered again, 224.81. The link to This Week in Earnings, where I get the forward EPS from, is in the description box below. That puts us at 17.63 times the index. 18 times is 404.56. And 17 times is 382.09. Bring it down to 16, you get to 35, 359.61. And I think 16x would be your recession concern level. That means if the concern about an impending recession rises and rises, and we're more and more concerned that the forward estimate on EPS is too aggressive, that we're not going to see 224, maybe we'll see 210. And if that becomes the story that's being told out there and the theme of the market, you could get to 16 times, because in recessions the multiple is usually 14 to 16, so that would put us at the top of the range, which is 9.25% below where we are now. That puts us down here at 360. If we look at our resistance and support levels, we have three technical resistance levels: 408.52 because of the upside gap, 408, that is the downtrend resistance level, 405.81 is the 200-day moving average, and 404.56 is 18 times earning. It would seem rather difficult to me to get to a multiple greater than 18 with recession fears rising and talk of recession rising. And if you look at the forward EPS over the last couple of weeks especially, it has been coming straight down. It is difficult to conceive of how the market could demand a higher multiple on a shrinking EPS with a looming recession. So I think 18 as a fundamental level is probably strong resistance to the upside, 404.56. But between the fundamental and technical levels, this zone here is a 40-point zone on the SPX. We have not, the last rally, we almost got to 40.50 on it before it started to pull back. It just didn't have the strength to get there. On the downside, your first technical level, your uptrend support, which is your uptrend line here, is 383.70. 72 or 17 times earnings is 382.09. 381.14 is your downside gap over here. That would fill your downside gap, and 378.05 is your 50-day moving average. That is a 57-point range or zone, resistance zone to the downside. We're sitting at 396.25. So 80 points up before you hit your first resistance level, which would be 18 times. It's a fundamental level. But from 396, you got maybe 160 points down before you hit your first technical support level, which is your uptrend. And then another, well, 7 to 10 points below that, you hit your fundamental level. Being that these overlap so closely, I'd say that on the index, if you get to 38.25 on the S&P index to the downside, that would be your near-term support, both fundamentally and technically. Personally, I think that that this kind of sell-off is a little bit too premature given where we are in the year, given that we're coming into the holiday season. The Santa Claus rally that we hear that every year. We have an inflection point in the Fed where we are expecting 50 basis points and a slowing down on the rate hiking cycle. So it really comes down to, I think the attention is going to turn away from the Fed quite significantly to the economy and recession fears. We had good retail sales over the past week, so the consumer is still there. I think Best Buy is reporting next week. Then there's another retailer reporting next week as well. I can't remember which one, but we'll look at it shortly. So we're really focused on, I think right now, the jobs market and the consumer. Those two, any information on jobs and consumer are probably going to elevate in importance right now, because that's going to tell us the strength of the consumer, and the strength of the consumer will tell us the strength of the economy and how many quarters ahead we're looking at a recession. All the indicators, all the yield curves, when I say indicators, all the yield curve indicators are saying, yeah, it's going to be a recession. You don't just have one inversion, you have a whole bunch of inversions. So some people say, well, the 2s to the 10s is important. Well, the 3-month to the 10-year is important. Well, the 3-month and the forward and the 18-month forward 3-month is important. Well, all of them are pointing down. So if we think that any one is a good indicator, when you have a whole bunch of them all indicating the same thing, it kind of appears that way. And if enough people believe that, then decision makers in corporations will be saying, given that we have an impending recession, maybe we should hold off on this level of investment and that level of investment. Maybe we should think about precautionary layoffs right now. And listen, we got to get rid of Larry in accounting anyways, right? This is a perfect cover. That they'll start making decisions and behaving in accordance with those indicators, thereby creating the very recession that those indicators indicate would happen. So that's what happens when you have strategic players in a complex system, is sometimes you have to look at certain indicators and say, well, they may not be indicating anything other than a change in behavior, which would then create the thing we think it's indicating. If you can follow that logic through. My break-even points, we had options expiration. I let some of my calls be assigned, so I do have a short position. You can see this red line up here indicates the level of my short position, which is just slightly below the market. It's a higher average price than I thought I would get. Doing the math in your head, you don't always get to where you want to be. Usually I'm within $1 of where I think I should be. I thought I'd be lower around 392. I'm sitting just a little under 395 on my break even. So with the current options that I rolled forward, my break evens are still sitting at 406.29 to 364.59 because the ones that were assigned at the strike, and I used the strikes to calculate my break evens before. So my 406.29 is kind of in the middle of the resistance zone, and my 364.59 unfortunately is well below the support zone. So if we break support, well, that's okay. I've still got a long ways to go to get to 364. If we get to our recession concern levels, we'll be at around 359. I'm sitting at 364. If I see that we're getting there, that means if we break down through the 50-day moving average, then I'm going to start thinking about what I can add to my deltas here to move my 364 closer to 360 and maybe even 355. Which would involve probably selling some December 350 or 340 calls. But I'm not going to do that unless we do have a firm closing below the 50-day moving average on a narrative in the market that is bearish because all the signs of a recession are there. Maybe the curve inverts from where it is, the 2s to 10s. Maybe it hits 100 points on the inversion. If it does that, yeah, I think you could see some accelerated selling. So as it stands right now, I really see the market having almost no motivation to get much above 18 times earnings. Now, if your earnings revision were going upwards, then yeah, I could see that you could justify higher multiples, but your earnings revisions are coming down. You have all the curves that are inverted. I just don't see a collective purchasing to get the index much above 18 times. Given the current market cap on the index, which is 32 point some trillion dollars, I did a quick calculation to determine how much money would have to come into the market for every 10 points on the index, which would be $1 on SPY. You need $84 billion. 84 billion. So to get 100 points up on the SPX, to go from closing of 39.65 up to 40.65 on just on money inflows to create a larger market cap, you'd need almost $1 trillion, $840 billion to get there. I just don't see that. I just can't see that happening because the equity market is now in competition with the bond market in terms of what is a nice yield to get. You know, you can sit in a 2-year and you're getting over a 4% yield for the next 2 years, and you're stepping aside from what could potentially be 10, 15, or 20% downside on the S&P, because we don't know, you know, if you are going into a recession, well, the equity market is going to have some downside, but you buy that 2-year bond, you're going to get that yield for the next 2 years, as long as you don't try to sell it in between there if rates go higher. It has low duration, so you're not going to lose that much even if you do sell it. But if you just want to park your money for 2 years, there's a place to go. Not only that, I've been hearing that this is through different asset managers who are on Bloomberg talking about you know, allocators and what they're reallocating to, and that there is a definite reallocation from a lot of pension funds and institutional funds, larger funds, to increase their allocation of fixed income away from equity, simply because the competition in yields is so nice. You can grab these 2-year and 5-year yields as opposed to taking your risk in the equity market. So to get 100 points up on the index, to ask for $840 billion to come into the equity market, again, that sounds like a lot, but it has a market cap of $32.5 trillion. So to get another $840 billion in, while the Fed is pulling liquidity out of the market by shrinking the balance sheet, while the fixed income market is giving significant yield competition and risk competition to the equity market, I just can't see how we're going to punch up above this resistance level given the constellation of everything we have. Inverted yield curves across a whole bunch of different curves, significant upside resistance, a lack of, I think, willingness to pay more than 18 times earnings for a shrinking EPS, and significant bond yields that are risk-free. unless I'm missing some really bullish component, I just can't see getting above these levels. So I think any push into this zone over here should be sold significantly, and I probably will. I don't know that I'm going to get that opportunity though, because I'm not feeling it. That if it were me and I had to flip a coin for Monday and say, well, on the open, blindfolded, what would I do? I would probably say the coin would land on sell more than buy. I have very little reason to buy at this point. Not that I got a lot of reason to sell, but if I had to pick between the two, I'd be a seller before I'd be a buyer. But at a lower multiple, if we got to a lower multiple, even with everything, you would say, yeah, but look at the multiple. The multiple is much lower. I'd be more willing to step in there. We're going to end it here because this is I'm going to end my analysis here. We still have the this week in earnings to look at for who's going to report earnings and the calendar for the week ahead, but it's not exciting. The calendar and the earnings are really not that exciting. We have a shortened week, Monday, Tuesday, Wednesday. I expect volume to drop into Wednesday. I think the only big story this week is 2 o'clock on Wednesday, which are the Fed minutes, and I think that'll be taken with a grain of salt because that meeting happened before we saw CPI and PPI. So I don't know that it's still going to be that relevant, but that's really the big thing Wednesday at 2. Then we leave at 4. We don't come back again till Friday morning, and we're only live for 4.5 hours, and then we're gone for the weekend. So let's see what we have there. Okay, I think all we really need to do is look at earnings here. Monday, you only have 3 companies reporting. What do we have on Tuesday? Before the market opens, you have Best Buy. A year ago, 208. The estimate here is 103. Look at that, a drop of 50%. And you have Dollar Tree as well, 118 estimate versus 96 a year ago. HP is sitting down here, a drop of 10.5% year over year, 94 down to 84. I think Best Buy will set a tone. It is measuring the consumer, so their guidance, I think, will be important. Walmart had good guidance about the consumer. Target had bad guidance about the consumer. Best Buy is really discretionary spending, whereas Target and Walmart, even though they're in discretionary in the discretionary sector, they are moving over to the consumer staples. They are better positioned over there. This will be pure consumer discretionary. We'll see what their guidance looks like. Next day you have Deere. Look at the difference here. A year ago, 412. The estimate is for 712, 72% increase. Cat really knocked it out of the park. Let's see if Deere can follow suit, even though they don't have necessarily the same customer overlap. They do involve the same type of investment decision from whoever's buying. Nothing on Thursday because we're closed. There should be nothing on Friday as well. I think the week, you could pretty much say the week ends Wednesday after the Fed gives its, after we get the minutes from the Fed going into the close of Wednesday. I think that's a wrap for the week, I think. Okay, so going into Monday, nothing really exciting here. You have one of the Fed districts activity index, Chicago Fed. Going into Tuesday for Canada, you have new housing price index year over year and retail sales. Forecast is negative, so that could, I think it would be worth watching the Canadian retail sales because it is believed that Canada is closer to a recession than the U.S. is. So this could be a look ahead as to what the American consumer would look like. So we can look at the Canadian consumer, and if they come in with a positive number as opposed to that negative 0.5, that could be good for the Canadian dollar as well, because that would signal that the economy can handle more rate hikes. Let's see, lots of Fed speak this day as well. Mester, you have George and Bullard, and you do have some Bank of Canada speak as well. Wednesday, mortgage applications, we get that every Wednesday. Building permits, the final look for October. Durable goods at 8:30, and continuing jobless claims as well. You have some PMIs, Michigan consumer sentiment. The big one is over here, is the FOMC minutes. I think that's really all that's going to matter for the week, is just what are we going to find in the minutes. And then you can see the rest of the week right there. November 24th, there's nothing going on. November 25th, there's really no economic data at all. And I think the morning of Friday morning, for the 4.5 hours we're open, I think volume is going to be low, and I wouldn't read anything into that. I think, as I said, as for most of us, the trading week is going to end pretty much once we get the FOMC minutes and we go home on Wednesday. That'll be it. One of the things I want to do is sort of position this. Some things are pretty self-explanatory for what we do. Jillian's place was self-explanatory. Big Brothers Big Sisters is. But when we start talking about mental health, it ends up being such an overused word these days to mean almost any behavior you don't agree with. That, when somebody sees something, they just refer, oh, it must be mental health. I see some homeless people, it must be mental health. I see a shoplifter, it must be mental health. I see somebody smoking dope, it must be mental health. It's been so overused. I don't want to risk people misunderstanding what your organization does, that it when I hear the term, I think, oh, here we go again with this thing again, this to release everybody from personal responsibility by saying mental health crisis. But if you could just give like a 3 or 4 minute description that narrows the definition, so that somebody listening could then say, I see now, okay, I understand that part. But I find we're so Americanized, and there's so much American influence, and it just seems that if you listen to CNN or MSNBC, everything's a mental health crisis, when it really isn't. Somebody who shoplifts just might be a thief, and is not having a mental health crisis, just might be a thief. The explanation you gave to me the other day of the difference between being nervous versus anxiety.
Stress and anxiety, yeah.
That was good, because now I know the difference. Now when somebody says, oh, I suffer from anxiety, I can then say, really? What does that mean to you? And then say, well, I get, before a test I get nervous. Well, that's nervous. That's, because what you said is that they start thinking about, where it could go, and then start getting really anxious about something that has never happened yet, or probably will never happen. So if you had to give like a 3-minute elevator pitch as to exactly what the mission of your organization would be, what would you say?
I wouldn't even need 3 minutes to articulate it. And what someone interprets versus what someone is experiencing or feeling is quite different. So anything that's no longer normal for that person could be identified as a struggle of some sort, whatever it is. So when we talk about a child feeling anxious or feeling depressed, it didn't just happen that day or for a few days. This has been a string of days that's been, continuing for quite some time, with really no reprieve, that we start to look at, okay, let's start talking about what this is. So depression isn't a sad day, a sad 2 days, a sad week. Depression is lingering sadness that continues for weeks upon weeks, sometimes months, years, without any kind of reprieve. Getting out of bed becomes difficult. Doing the everyday tasks you used to do all of a sudden is of no interest. So it's really about pattern changes in people. And when we see kids at Pathstone, that's exactly what's happened. There's a pattern change. There's a delay of some sort in development for them, because in children, they've got ages and stages, right? Like, what should my child be doing approximately at this age in their life, in this stage of their life? And sometimes we can identify just what it is, which is a lagging skill, and they may catch up on it, or they may need some intervention or support to be able to help them get over that hump, let's say. So when we talk about mental health issues, it's not supposed to be an excuse, of course, for any kind of bad behavior. But sometimes when you look at those that get into drugs, alcohol, um, oftentimes it's what led to the drugs, what led to the alcohol, or the high risk behavior, right? And so a lot of times we can point to a mental health struggle that was just suppressed, ignored, never really surfaced. And we talked about childhood trauma when you and I met, and how sometimes that doesn't surface for dozens of years in a lot of people.
Like how young is young? It seems to me that personalities and characters take a while to develop to determine whether or not this is the terrible twos or if this is something more than that. So,
Mhm.
at what age would you think that? Um, I'm finding it hard to ask the question that I want to ask is how young does your organization go, knowing that that is clearly old enough to be something more than just a child acting like just a difficult child to deal with, but that will grow out of it.
So I'm probably going to blow your mind now in telling you that our services start from the start of a child's life and continue until they turn 18. So we do have an infant mental health program, and it actually has great success. And when we talk about infant mental health, you're probably thinking, well, how would an infant articulate in any form a mental health struggle? And a lot of times we're looking at parenting, cyclical mental health issues that will repeat themselves. If a parent doesn't know appropriate childhood experiences because they never had them, they will, in fact, raise their children in the exact same way, which perpetuates this cycle. Our infant mental health program actually teaches them appropriate childhood experiences versus adverse childhood experiences to better parent, to nurture, to bond, to get that relationship going. And it does start very young when neurotransmitters are still connecting. The brain, as we know, develops not fully until age 25. So there's lots of time in that very, very vulnerable point in a child's life at birth and in the first 2 years of development where we can have a significant impact on the future of that child and actually of that family. I'll give you an example. There was a woman who had a child already, and the child was taken away by fax because the mother was not, and she will say, I was not in any shape to raise this child appropriately and provide for them. And she took our infant mental health program because she was pregnant with a second child, learned appropriate childhood experiences, now has both children in her custody fully, and is raising them completely different. So a lot of times it's, skills and tools.
Facts is what?
FACS is Family and Children's Services. So they will intervene if they feel any child is not in a safe, supportive, loving environment if they're in danger.
Oh, okay. So that's targeted to the parent, not the baby. Like, obviously, you wouldn't take a 6 month old and start counseling the 6 month old on how to behave. It's targeted towards the parent so that the child will not fall into a particular cycle. Correct?
Well, it's about nurturing an attachment and bonding that is so important for a child. If a child is neglected at birth, that will surface later as mental health issues. We've got science that proves that. That's why we talk about after a child's born, we put them on the mother's we do skin to skin contact because it develops that bond and that attachment, both for the mother and for the child. It's that same type of strategy. We go over those same skill sets and exercises when we host that program.
So how many I'm gonna just call them units. Unit being a mother with a baby, call that one unit, whereas a 14-year-old might just be a 14-year-old. How many units do you have in your system now?
So over the last 2 years, we've had 20,000 access points. So our services, whatever they are, from the infant mental health program, which goes, 8 to 10 weeks, to a grief therapy program, which can run as long as a year, to a brief services program, which is 6 sessions or less. We've had our services accessed 20,000 times over the last 24 months.
And the people accessing the service don't pay for any of it. It's all donations that help fund that help fund this. So the donations that when we sell the hats, and I'll be matching whatever we sell a hat for, I match it, and then we give a donation. That then goes to support a particular program, or what's a typical program that gets supported?
Yeah, so at Pathstone Mental Health specifically, we are funded by the Ministry of Health to the tune of just under $9 million a year. It costs us just under $13 million to operate, at least in the last year. So we've got a $4 million shortfall to make up for. We do have other ways we access funding. We have a paid parking lot at one of our sites. We have tenants at one of our sites. So there is some income that comes in that form. But really, the majority of it is community support donations through individuals, corporate audiences, grants, donations of stock, insurance, shares, like all, wills, gifts left in wills. And yes, that is what makes up the rest of it. So what we're able to do with those donations, we bought a brand new site. Well, not a brand new site. We bought a site in Welland that will be a brand new site after we're done renovations, that will service Niagara South and probably over 3,000 kids a year just at that site. It's at the opposite end of the region. It makes accessing services like a snap compared to coming all the way to St. Catharines for services. So that is something that was funded by donations to the foundation. We have outdoor learning and play hubs at our school that really unleashes creativity and the power of learning for kids that are struggling in school already. We have 9 walk-in clinics across Niagara, so you can pop into any one of our locations across the region, no cost, sit down with a counselor one-on-one and have a session. That's fully funded through the foundation. So while we love the fact that we are funded by the Ministry of Health, it only gets us this far. And if we want to continue to evolve, be innovative, and service more children and youth, we need the foundation to support the rest of those programs.
Okay, that was it. I already had my screencast going, so I got the parts that I need. I'm just going to cut certain parts out and add them to the end of the next Market Outlook video. And then that was all I needed.